captures a pivotal moment in the escalating trade tensions under President Trump's second term, revealing how Asian markets are demonstrating resilience despite mounting tariff pressures from the United States. Market divergence, Asian optimism versus American pessimism. The stark contrast between Asian and American market reactions tells a compelling story of regional economic dynamics. While Wall Street suffered its worst day since mid-June, with the S&P 500 falling 0.8%, Asian markets largely shrugged off the tariff announcements. South Korea's Kospi led the gains with a robust 1.8% surge, despite being directly targeted by the new tariffs. This suggests that Asian investors may be viewing the current trade rhetoric as negotiating tactics rather than permanent policy shifts. The muted response from Asian markets reflects what Stephen Ennis of SPI Asset Management described as treating the tariff announcements as more background noise than breaking news. This measured reaction indicates that investors in the region have developed a tolerance for Trump's trade brinkmanship, having witnessed similar cycles of escalation and de escalation during his previous presidency. The tariff landscape, scope, and strategy. Trump's latest tariff announcement targets a broad range of countries with 25% levies on Japan and South Korea and rates reaching up to 40% on Myanmar and Laos. The timing is particularly significant, as these tariffs are set to take effect on August 1st, following the expiration of a 90-day negotiating period that Trump had previously extended. The tariff strategy appears designed to pressure allies and trading partners into renegotiating trade deals. Trump cited persistent trade imbalances with Japan and South Korea, two crucial U.S. allies in Asia, suggesting that even close diplomatic relationships won't shield countries from economic pressure tactics. Corporate casualties, the Tesla Trump rift. The Tesla stock plunge of 6.8% highlights how political tensions can spill over into corporate valuations. The conflict between Elon Musk and Trump over the Republican spending bill represents a significant shift in their relationship, with Musk threatening to form a third political party. This demonstrates how individual corporate leaders can become caught in the crossfire of broader political disputes, affecting shareholder value regardless of business fundamentals. BRICS and the broader economic chess game. Trump's threat to impose an additional 10% tariff on countries aligning with BRICS policies represents a new dimension in trade warfare. This move essentially weaponizes trade policy to influence geopolitical alignments, potentially forcing countries to choose between economic relationships with the U.S. and participation in alternative international frameworks. The BRICS threat encompasses major economies, including Brazil, Russia, India, China, and South Africa, along with newer members like Egypt, UAE, and Ethiopia. This broad reach could significantly reshape global trade patterns if implemented, as countries may need to recalibrate their foreign policy positions to avoid economic penalties. Market psychology and historical precedent. The relatively calm response from Asian markets suggests that investors have developed a sophisticated understanding of Trump's negotiating style. As Ennis noted, markets didn't lurch because they've seen this show before, indicating that traders are distinguishing between negotiating postures and actual policy implementation. This market maturity reflects lessons learned from Trump's first presidency, where tariff threats were often followed by last-minute deals or extensions. The current 90-day extension pattern mirrors previous approaches, suggesting that the administration views tariff threats as leverage rather than desired outcomes. Economic implications and recession risks. The report's mention of potential recession risks underscores the serious economic implications of sustained trade tensions. Higher tariffs typically lead to increased consumer prices, reduced trade volumes, and potential supply chain disruptions. For Asian economies heavily dependent on exports to the U.S., sustained tariff implementation could significantly impact economic growth. However, the current market response suggests that investors are betting on eventual resolution through negotiated settlements rather than permanent trade barriers. This optimism may be justified given historical precedent, but it also creates vulnerability if negotiations fail to produce satisfactory outcomes. Currency and commodity reactions. The relatively stable currency movements, with the dollar trading at 146.07 to the yen and the euro rising slightly, suggest that foreign exchange markets are also treating the tariff announcements as temporary negotiating tactics rather than fundamental shifts in economic policy. Similarly, the modest declines in oil prices may reflect concerns about global economic growth rather than panic selling. This measured response across multiple asset classes reinforces the interpretation that markets are viewing current developments through the lens of previous trade negotiations rather than as unprecedented economic threats. The situation represents a critical test of whether Trump's trade strategy will achieve its stated goals of rebalancing trade relationships or whether it will lead to sustained economic tensions that could ultimately harm global growth. The divergent responses between American and Asian markets suggest that the ultimate outcome may depend more on negotiating skills and political flexibility than on the initial tariff threats.